Moving to our other segments, Asia Pacific revenues net of expenses were $1 million. As I mentioned on our last call, growth in this region will depend on our on-site sales distribution locations, which are much more efficient sales channels than off-site. Therefore, going forward, we are focusing our efforts towards future inventory acquisitions with high-volume on-site sales distribution potential. We continue to identify opportunities for development margin improvement, and with that in mind, we are closing our off-site sales locations in Hong Kong and Japan in the fourth quarter. We expect these actions to provide roughly 10 percentage points of marketing and sales margin improvement in this segment going forward. We anticipate the costs associated with these closures to be between $4 and $5 million, the majority of which will be included in our fourth quarter reported results.
And our first question is from the line of Eli Hackel from Goldman Sachs. Please go ahead.
Morning, Eli.
Good morning. Just on Asia, just talk about your growth expectations there. Obviously, you're going to look to be a little bit more efficient. Do you think you'll grow Asia contract sales next year?
And Eli, this is Steve. Let me address your Asia question. I think it's important that we kind of go back just a moment and talk about kind of how we've gotten to where we are. When we first started our new points-based program in Asia, which was 5 or 6 years ago now, we anticipated starting with some off-site sales locations and filling in with on-site distribution, which, as we've already spoken about, the on-site is much more efficient from a sales cost standpoint. Having said that, we also needed to generate some sales to begin with, and it was easier to start up some off-site. So we were well on that track until kind of the bottom fell out of the economic market, at which point in time Marriott asked us to stand down on any new development that we had in Asia. In fact, we had a hotel that we were going to convert to timeshare in that region that we ended up, we owned it, we ended up having to sell it, et cetera. So what we were left with was an imbalance of too much off-site and not enough on-site. So what we have been about for some time now is been out trying to identify new development opportunities where we will be able to establish an on-site sales presence in markets that we believe will generate substantial growth for the business. As you might imagine, it takes a little time to make that happen, and we're not in a position to be able to announce something yet, but I can tell you I think we're every time we have these calls, we get increasingly closer to being able to do so. So whether 2013 will see a material increase in sales, in fact, I would say it would probably go the other direction because for the first 3 quarters of the year, we actually had both Hong Kong and Tokyo in as the revenue generators. However, they were not profit generators because of the high sales and marketing costs. So I think 2013, you won't see a substantial increase in revenue. In fact, you'll see a decrease, but I think you will see some improvement in the margin of the business we do in Asia Pacific.